2025 didn't break hospitality. It normalized it. After 3 years of historic travel highs, the sector finally took a breath. And inside that pause, the real winners and the real trends revealed themselves. 2025 wasn't a down year. It was a cooling year, the kind the industry needed. Occupancy slipped roughly 1.5%, landing near 62 to 63%, still just a few points below 2019 levels. Supply grew 0.9%, demand dipped 0.6%, and the momentum of the 2021 to 24 surge finally leveled off. A DR, after 2 years of double-digit growth, hit a plateau, flat overall, still near record highs. RevPAR dipped 1.4%, not from weakness, but from normalization after the strongest travel rebound hotels have ever seen. This wasn't a retreat, it was equilibrium. Leisure remained the backbone. Drive to markets, beach towns, mountain resorts, all still posted strong weekends. Urban hotels finally woke up, midweek occupancy rose, conferences returned, and corporate travel crept back into the cycle. Cities like St. Louis posted 13% RevPAR growth, proving group demand had life again. But 2025 wasn't led by hotels doing better. It was led by the world around them changing. Travel diversified. International trips surged. Cruise lines ran at 100% capacity. Short-term rental demand ran 30% above 2019 levels. The lodging pie got bigger, and hospitality shared the stage again. While traditional hotels faced softening, extended stay barely noticed the cycle shift. Occupancy ran 11+ percentage points higher than the hotel average. ADR held its line. RevPAR dipped only a fraction of what traditional hotels saw. Because extended stay doesn't rely on weekend leisure, it runs on base demand. Construction crews, infrastructure workers, insurance-displaced families, healthcare rotations, long-term relocations, corporate project teams. This is demand that doesn't fluctuate with airfare or vacation trends. It's stable, predictable, durable. Extended stay wasn't just resilient, it carried the sector. It was one of the only segments still seeing new development, especially across the Sun Belt, because the economics stayed convincing even as debt costs rose. Operators kept ADR high, nationally around $155 to $160. Guests accepted the pricing, but margins tightened. Labor remained tough. Hotels averaged 17 job openings per 100 rooms. Wages climbed, insurance climbed, utilities climbed. Everything that makes a hotel run cost more. The result? Revenue near highs, profit flat. So operators adapted. Leaner staffing models, opt-in housekeeping, mobile check-ins, automation where possible. Hospitality wasn't struggling, it was modernizing under pressure. 2025 wasn't a distressed market. Hotel delinquencies stayed around 4 to 5%, far below the trouble seen in office. Investment volume did slow. Higher interest rates forced 50 to 60% LTV deals and muted underwriting. But investors were selective. Resorts with pricing power, limited service portfolios, and extended stay assets drew the most bidders. Extended stay trades landed in the 7 to 8% cap rate range, a compelling yield compared to other CRE segments. Urban full-service hotels struggled, but even they attracted opportunistic buyers positioning ahead of a potential rate cut. 2025 wasn't a capital retreat. It was capital choosing winners. Inbound travel improved, visa backlogs eased, and restrictions vanished. Cities cracked down on shadow short-term rentals. New York's enforcement alone pushed thousands of illegal Airbnbs offline and boosted hotel weekend occupancy. Labor negotiations raised costs but also drove tech adoption across the industry. Policy didn't solve problems. It removed obstacles. 2026 won't be a surge. It will be a steady rise. RevPAR up 0.5 to 1%. ADR gaining around 2%. Occupancy holding or nudging upward. Business travel expands. Group demand strengthens. Inbound tourism improves, especially from Asia as flights return. International events, including the World Cup, drive spikes across host cities. New hotel supply stays extremely limited, under 1% net growth, tightening the market further. Extended stay continues to outperform, absorbing new inventory as fast as it opens. 2026 isn't a boom, it's the year stability turns into controlled momentum. 2025 wasn't a step back for hospitality. It was the cooling period the sector needed. Extended stay became the stabilizer. And in 2026, that stability turns into steady growth.